if commercial real estate isn't the most hated asset class in the world, it's pretty close. And I think office might be the most hated asset class in the world. People don't care as much when they're making less money. So tiering is a lot more pronounced right now because a rising tide is not lifting all boats to the same degree.
Richard is a senior managing director and head of global research and strategy at Principal Asset Management.
But let me give you an example of where we think there could be an opportunity to build new product. You're probably going to fall out of your chairs when I tell you this.
All right. Welcome, everyone. My name is Jonathan Spitz, and I am the host of the Redirect podcast, and I'm joined by my other co-host, Storm Murphy. And today we're going to be taking a deep dive into the state of the commercial real estate market, what asset classes we could perform in 2026 and beyond. And, we're really privileged today to be joined by our guest, Richard Hill. Richard is a senior managing director and head of global research and strategy at Principal Asset Management. And me personally, I'm personally excited to have this conversation. So I actually learned about Rich maybe a year or so ago through LinkedIn. And I believe Rich was going back and forth with somebody in the comments. I believe it may have been CRE analyst, who's another great follow on LinkedIn. But I just really appreciated the candidness and bluntness. And ever since then, I've been following his work over at Principal. So again, really, really grateful to have him here with us today.
Thanks for having me, guys. I'm looking forward to our conversation.
Yeah. So would love to just start with some background. So I believe you came from a real estate family, but that wasn't the career you pursued initially. Is that right?
Yeah. So I grew up in a real estate family. My dad was a mall manager. I like to tell people that that means he managed malls for other people when he did not own malls. A very, very important distinction. I had no desire to get back into commercial real estate because who wants to follow their dad into a market that was boom and bust in the 1980s and the 1990s, and frankly, even a lot of the 2000s. But as luck would have it, when I graduated undergrad, I was put on the interest rate derivatives desk at a Wall Street bank, covering commercial real estate developers and home builders. So sort of the rest is history. I moved over to the debt capital markets team shortly thereafter. Did that until 2008 when I was told my services were no longer needed. Went to work with my dad for about a year, decided that was not for me, and then recreated myself as a research analyst, first on the debt side of the business, then covering debt and public REITs, and then most recently on the private equity side of the business. So I like to tell people that we take a holistic view to commercial real estate, covering the four quadrants, public and private, equity and debt. We think it's really important to look at the market that way because it sends signals and it helps you connect dots.
Yeah. So I guess just a quick follow-up to that. I would love for you to talk a little bit about reinventing yourself at that point, right? Like this is, 2008. And, I know that certain people are going through that right now, right? As we, across certain asset classes or just across certain sectors, you're seeing higher unemployment. What was that like at the time? And ultimately what led you to pivoting in the direction that you did?
Yeah. The short answer is it was terrifying. I had a remarkable job being a debt capital markets banker, traveling the world, was married but didn't have kids, and being told you no longer have a job in January 2008, 3 months before my first child was born, that's really, really tough. So the reality is you scrap and you claw, and you try to find a way to add value. I was lucky enough to join the CMBS trading desk at Royal Bank of Scotland. How did I join Royal Bank of Scotland? Well, when I was at B of A, we had a really good relationship with Bear Stearns. We shared a commercial mortgage-backed securities shelf. And when Bears failed, half the team went to JP Morgan, half the team went to Royal Bank of Scotland. I tell people that the team at RBS was looking for a non-traditional research analyst to join their team. And you couldn't find anyone more non-traditional than myself because I had never written a research paper before. But I did know a lot of things about securitization. I knew a lot of things about distress because I helped work out some situations in 2007 and in early 2008. And so sort of the rest is history. What I learned is that people like objectivity. People like a straight shooter. And, I'm not always going to agree with my investors. But if you're true to yourself and you remain objective and you're steadfast over time, I think people really come to appreciate that.
Mm-hmm. Yeah. Yeah, Rich, your background in on the derivative side, in Wall Street, debt capital markets, would you say, there's any specific moment, any specific lesson that you learned in those earlier days that have really kind of been a framework for you in your research today, or maybe you have a different lens than most other people in commercial real estate today?
Yeah. So let me first explain how we think cycles play out, and I'll go back and answer your question. We are a very big believer that listed REITs trough first. They're leading indicators in both downturns and recoveries. Private valuation troughs 12 to 18, sometimes 24 months later. And then distress in the debt markets peaks out only 12 to 24 months after private valuation trough. So distress in the debt markets is actually a lagging indicator. Why am I leading with that? Well, I spend an inordinate amount of time for someone like myself thinking about the debt markets. Some of that's because I was a debt capital markets guy first and foremost, so it's my first love. But I'm a huge believer that debt markets sort of drive commercial real estate. Why is that the case? Well, commercial real estate is inherently a levered asset class. Not many investors buy an office property or a retail property or industrial property and don't put some level of debt on it. So understanding how the debt markets are influencing valuations is really important. And by the way, that doesn't necessarily mean a good thing. That also can mean really bad things. I vividly remember a very senior CIO at an asset manager emailed me very early in my career at Morgan Stanley and said, "Hey, Rich, you don't understand what is going to happen to commercial real estate when interest rates rise. There is not going to be enough net operating income growth to offset the rise in financing costs." And more than anything, I remember sitting on my grandparents' stoop in Bardstown, Kentucky, and I just remember reading that. And it was something that he wrote in 2013 that actually didn't come to fruition until 2022. But that's probably one of the most pivotal moments in my career when someone said, you just have to think about the interplay of how all of this works. It's not rocket science, just sketch it out.
Yeah, I want to touch on that point because I remember when we first spoke a month or so ago, that's one thing that really stuck with me is, public securities trough first, then private, then debt. So can you explain maybe why that sequence is the way it is and why it tends to repeat itself? Maybe not history, maybe it doesn't repeat, but it does rhyme. So why does that tend to flow that way?
Yeah, I describe it as the grieving process. I know that sounds really funny, but there's denial, then there's anger, and then there's acceptance. So why does the cycle play out the way it is? Well, first of all, listed REITs are non-emotional. They're publicly traded. You can get a valuation every single minute of every single trading day. And guess what? The public markets are pretty efficient. The public markets lead, and the public markets will tell you at cycle shifts where valuations are going. Can public markets act irrationally like my 9-year-old from time to time and overreact to the upside and the downside? Sure. But at cycle turns, they tend to be very non-emotional. And as a result, they're leading indicators in both downturns and recoveries. The private markets are inherently more emotional because you have humans, not trading machines, but you have humans putting appraisal valuations on properties, and you have bid-ask spreads on when you're trying to figure out transaction prices. Both are emotional because appraisal values, you're putting some human objectivity into it, and transaction volumes are inherently very emotional because oftentimes at the beginning of cycle downturns, sellers don't want to sell at the price buyers want to buy at. So that's why transaction volumes fall. What ends up happening though, and I think what surprises most people about the debt markets and why it's a lagging indicator is because it is the final stage of the grieving process. It's acceptance. For two reasons. First and foremost, banks do not like to resolve distressed loans into a distressed market. They like to resolve distressed loans into a stabilized market. So you actually see distress rise as the cycle is actually in the recovery stage. The second part of this is the emotionality of a borrower. A borrower does not like to return the keys to a lender when there's still hope that tomorrow might be better than today. And by the way, commercial real estate investors are a really, really optimistic lot. Not until you recognize that tomorrow is not coming back do you actually make the hard decisions on what you're doing with your outstanding debt. And so it's just being a lagging indicator. And frankly, when we see distress rising and delinquencies rising, we get really excited about that because we think it's a really clear indicator that you're supposed to be buying low and selling high. Unfortunately, a lot of people in the commercial real estate market tend to want to buy everything when it feels really good and sell everything when it feels really bad. My job as a research analyst is to be objective and non-emotional about it as much as I can be.
Let's talk about your job is on the research side and how you work together with your investment teams. Can you kind of walk us through how your department and you specifically intersects with the deal team at Principal? How does your work influence deal sourcing or investment decisions? And ultimately, does that have an impact on what makes it maybe into the deal pipeline or a broader investment strategy about what the firm is pursuing, whether it's over the next 12, 24, 36 months?
Yeah. Well, so first, let me say that as a research analyst, I come from an investment background, not an economics background. A lot of my peers come from an economics background and are quite frankly much better than I am about telling you what factors are going to drive revenue growth or net operating income growth for a given property in a given market. But where I spend a lot of time is twofold. I take my strategy role extremely important. So I am constantly engaging with our portfolio management team on, all right, what do you like? Why do you like it? Do we actually own that? And if we don't own it, should we be buying it? And if we own the wrong thing, should we be selling it? So I just spend a tremendous amount of time making sure we have a top-down thesis and we're executing on that top-down thesis. But there's also another role, which is the bottoms-up role. I'm a voting member of most, if not all, of our investment committees across both funds and separate accounts. We're constantly thinking about what properties we should be buying in a given market. And so usually nothing comes to IC unless we've already thought through it. We mirror top down with bottoms up. I think a lot of people say that, but we try to really execute on it.
Rich, wanting to just get into a little bit of your views now. So I know kind of the mid-year report in talking about some of the macros. So it sounds like your view is that growth will slow over the next year. Can you walk us through, what factors are predominantly driving that?
Yeah. So from a macro perspective, I think the world has changed pretty significantly over the past 6 months. And the U.S. economy, as well as global economies, have proven to be a lot more resilient than certainly I was expecting, and a lot of people were expecting. Why is that the case? Well, I think it's for 3 primary reasons. First, the impacts of tariffs have not been as severe as what people were expecting, both because the effective tariff rate has come down from the worst case scenario, but it also seems like a lot of companies are actually absorbing the tariff rather than passing it on to the consumer. The second point, which I don't think the market spends enough time on, is there was a lot of stimulus that came through from the tax bill. And the impacts from the stimulus actually almost one-for-one offset any headwinds that came from tariffs. So we sort of went round trip. But there's a third point that I don't think is going to surprise anyone, but it's the impacts of AI spending on GDP growth. In the first half of 2025, it was around 50% contribution to GDP, which is a really big number. I think some people are beginning to ask, is that a double-edged sword? Meaning, yeah, great, there's a lot of spending and it's helping GDP, but what if that spending goes away? What does it do? What does it happen? We don't think we're anywhere close to a recession right now. We think it's too early to call for a recession, but that doesn't mean it's all puppy dogs and rainbows in the macro backdrop. We call it a very mixed macro backdrop. There's some economic signals that are flashing green, there's some that are flashing yellow, and there's some that are flashing red. And that creates a very confusing market to navigate. But against that backdrop, I'm sort of using the KISS method of investing, keep it simple, stupid, control what you could control, which is just focusing on net operating income growth. And if you can do that across markets, I think you can be successful. And there's a lot to unpack there, but ultimately what I'm really calling for is a back to basics, an old school investment philosophy where fundamentals are going to drive returns, not financial engineering, which sort of dominated from 2010 and beyond.
Yeah. And so can you unpack that a little bit? What does that mean? How did financial engineering drive returns over the last decade versus, what maybe historically has been more of a fundamentals based market?
Yeah. The short answer is global central banks reduced interest rates to historically low levels in the aftermath of the GFC and then the aftermath of COVID. That occurred at a time that inflation was falling. So I like to tell people, I get asked all the time, what do you think about this new normal environment of hyperinflation and higher interest rates? This is not a new normal environment. This is an old normal environment. What was really weird was 2010 until 2022, when you had historically low interest rates and falling inflation. What does that do? Well, it incentivizes two things. It incentivizes debt, because debt is highly accretive in a world where you can finance things at next to nothing. And it also incentivizes what I refer to as puppy dogs and rainbow investing, where you can go way out the growth curve and discount that back at zero interest rates. So effectively what that did is it created a market that was turned upside down. Where the vast majority of returns since 2010 were driven by appreciation returns, not income returns. That's historically abnormal. Usually income returns are driving commercial real estate, not appreciation returns. Now you can have a little bit of both, but when you think about core real estate's generally an income-driven, bond-like investment with an equity-like kicker to it. But appreciation returns dominated over the past cycle, which usually isn't the case. And I think it can incentivize risk-taking in maybe a way that isn't always prudent.
Yeah. And how do you think that that's impacted the valuations in the market? Like, as an example, so I've been in the real estate space for about a decade, and I can't tell you how many, whether it was experienced managers or even newer managers from that, let's call it 2015 to 2020 time period, where, many managers would go in, execute a value add strategy, and maybe they wouldn't get the uplift in rents that they originally projected, but they would still make money because multiples had expanded over that period, right? And cap rates had come down. So essentially mistakes could get, masked over by multiple expansion. So what do you think that means going forward for, for managers that have only been operating in this environment, right?
Yeah. Commercial real estate total returns have risen for 5 consecutive quarters for core open-ended commercial real estate funds. Every single headline CRE index is above its trough at this point to various different degrees. So we do think we are clearly in the recovery stage of the cycle. But I don't think this is going to be your grandparents' commercial real estate recovery, where you have a beta up and to the right. What does that mean? Well, we're actually seeing really significant tiering across property types in top 50 markets. The top quartile of properties across most markets are up more than 10 to 15% from their trough. Some are up even more than 15%. The bottom quartile is still lagging. Why am I leading with this? I want to come back to the question you mentioned. There has always been tiering in the commercial real estate market. That's what it is. You buy the right property types in the right markets. Shocker. No one cared about the tiering from 2010 to 2022 because everything was doing well to various different degrees. So to your point, you could have bought the worst property types and you still produced generally pretty good returns, even if you were lagging your benchmark. Now, I think tiering matters a lot more because you have some markets that are not growing anymore. You have some markets that are not putting up much price appreciation. That actually really matters because people care when they're not making money. People don't care as much when they're making less money. So tiering is a lot more pronounced right now because a rising tide is not lifting all boats to the same degree. And I think it's going to make property type selection paramount, market selection paramount, but also one other thing really, really important. You're actually going to have to operate these assets. You didn't have to operate these assets previously. And guess what? I'm not an operator. I don't manage our properties, but it's really freaking hard to manage properties. You actually have to lease. You have to block and tackle. You have to use every other cliche word you can think about. It's really hard. And I think just operating assets, that's going to be a huge driver of alpha.
That's great. Rich, I wanted to ask, in this kind of hidden recession or correction, say, of real estate of the last couple of years, could you just give some insight into what you've seen, what has really made this a correction? Maybe even across assets. Some of our investors have been speaking about multifamily distress or a deal they participated in that has gone south. Even across assets, what you've seen, you mentioned the trough has happened in 23, but how did we get there?
So this has been a really different recession for commercial real estate than what we've historically seen post the GFC, post the S&L crisis, the early 1990s. And even, if I want to date myself a little bit and be a complete research dork, what happened in the 1970s. This is very different. And the reason it's different is for two reasons. First, fundamentals have actually held up really well. Basically the office sector. So if fundamentals are holding up well, why did property valuations go down so much? Well, guess what? You had 10-year treasury rates go from, being facetious here, 0% to north of 4% in a very, very short period of time. What that means is your cost of financing went higher. And if your fundamentals are stable, but not improving, that means your margins compressed, your returns compressed. The only way you get returns to go higher is for valuations to go down. This is simple bond math, right? Rates up, prices down. And so you have to have that correction play out. The second point, though, which I actually spent a lot of time on, is it is very abnormal for commercial real estate valuations to decline when the economy is on really strong footing and, frankly, the housing market is booming. Usually, commercial real estate ebbs and flows with risk assets. That's not what happened right now. We had a massive, massive disconnect that emerged over the past 2.5 to 3 years. There's a lot of people out there that say, hey, look, I don't think commercial real estate is what it used to be because it has underperformed while everything else has outperformed. We think that's a real opportunity. I'll give you a great case in point. If you look at the housing market versus commercial real estate total returns are now handsomely above house price appreciation in the United States. You're talking about commercial real estate total returns on a year-over-year basis being close to 5% and house price appreciation on a year-over-year basis being at 1.7%. But just like I talked about tiering in the commercial real estate market in this recovery stage, we're now starting to see tiering in the housing market. So of the top 100 markets in the United States, 60% of them are still rising, 40% of them are declining. We think that we're going to start to see an environment where commercial real estate begins to outperform other risk assets. You guys said at the beginning, no two cycles are the same, but sometimes they rhyme. I think if you squint hard enough, this starts to look and feel a little bit like the late 1990s into the early 2000s. Why do I say that? Well, in the late 1990s, public REITs were underperforming because of rising interest rates, a love affair with .com, and deregulation of telecom, which took demand away from REITs into another defensive sector. But lo and behold, in the early 2000s, commercial real estate and REITs had some of their best years ever, even as the U.S. was moving into recession and risk assets were pulling back. Fast forward to today, commercial real estate's underperformed because of rising interest rates, a love affair with tech, and utilities taking maybe some of the defensive demand away from commercial real estate given that utilities are a second derivative play on AI. So I think there's a real environment where people are going to begin to recognize that commercial real estate can be a great diversifier within portfolios. Income returns are really stable, and you're going to start to get price appreciation. And if you buy into our thesis that you can have significant alpha through effectively a stock picker's market, as cliche as that sounds, I think some managers are going to do really well. I think some managers are not going to do as well. What I'm ultimately trying to say is, if you take a step back and are non-emotional about it, this sell-off, this downturn in commercial real estate actually makes a lot of fundamental sense. But I appreciate why it's really confusing for a lot of people, because it feels like, well, this is happening, this is happening, this is happening, but they're all sort of connecting the dots, and they all make sense in unison.
I want to talk about markets specifically, because you talked earlier about that balancing. Some markets aren't growing, some are. What we definitely have seen over this previous cycle is that supply was largely following demand, right? So the markets that are growing the fastest also saw, we just recently saw a 40-year high in apartment supply. 70% of that was delivered in the Sun Belt. So when you look at performance over the last couple of years, what you've seen is a lot of these very high growth, really strong population growth, really strong rental demand, have not fared as well when it comes to rent growth because of how much supply was built versus, let's say, the suburbs of Chicago. I mean, talk about, a market that isn't growing. That has been one of the strongest performers when it comes to rent growth. So how do you, when you guys think about that, when you think about market selection at Principal, how do you balance some of the more secular demand drivers like population growth, job growth, business-friendly states versus supply and demand, and how you kind of weight those two and when it comes to making market selection decisions?
I think everyone understands the headline that the U.S. is underhoused by, pick your number, 5 million, 6 million, 7 million, 8 million homes. We think that's mathematically true, but it's actually misses the debate. We do not have an undersupply of housing problem in the United States. We have a housing mismatch problem in the United States. What does that mean? Well, we build way too many types of certain houses in some markets, and not enough types of other houses in other markets. So to your point, we have seen a tremendous building boom in high growth Sunbelt markets. So that has put a tremendous amount of supply in the market. But guess what? No one builds Class B and C apartments. No one builds affordable housing apartments. People only build conventional Class A apartments. There is a real chance that in some markets, we have an oversupply of conventional Class A apartments relative to the growth that we've seen. And so what we do is we do state by state, we do a city by city, and we do a county by county analysis where we're looking at household formations. That's different than populations. We think household formations is what you need to look at relative to the supply of stock that's come over a certain period of time. And when you do that, you can start to see that some markets have built too much and some markets have not built enough. That does not mean that we're shying away from high growth markets, because some high growth markets are really great. You just need to buy those properties at the right valuation where, pick your number, your IRR, your multiple, your cash on cash return, makes sense. And by the way, some of these markets, we do think that you can buy significantly below replacement cost. I'm not a big believer that replacement cost is an end all be all thesis. What replacement cost tells you is you should be able to push rents over time. And that ends up being really attractive. But on the other hand, like to your point, guess what? The Midwest is just booming right now from a rent growth standpoint. And so we talk about things like Chicago, but guess what? Louisville, Kentucky is a really good market. We're also seeing markets like Chattanooga, Tennessee, Knoxville, Tennessee, Greenville, South Carolina, Huntsville, Alabama. I can go on and on and on. You're starting to see these transformational economic booms that are occurring. That's a research term that means absolutely nothing, but it sounds really good. It's becoming a much more nuanced market. So look, some of these high growth markets are going through what I refer to as growing pains. Rents have increased a ton. They're not as affordable. Guess what? If you move to Charlotte, North Carolina, where I grew up, traffic's terrible. So it's just a really interesting market. So we spend a tremendous amount of time thinking about long-term growth prospects on a market-by-market basis. We have to be cognizant of near-term supply because supply versus demand really matters. But we're trying to buy undervalued markets relative to their long-term supply versus demand characteristics. It's sort of as simple as that, but that's actually really hard to do.
Rich, if we were going to talk about supply and where we had record highs, where starts are falling off a cliff, if we're going to have a question of build versus buy and why everyone becomes very attractive to the shiny headline markets, brand new high-rise development, do you have a take on where that's going? If now, when starts are down a ton, it may be a good time to start building, where some can only finance deals with TIF money, being very selective in certain markets, maybe some smaller Midwestern markets, not big projects, or maybe you need scale. I guess you have a take on the build versus buy discussion.
Everyone talks about the negative impacts of tariffs, but there's also a positive impact. It's hard to build things. Raw material costs are high, financing costs are high, labor costs are high. It's in a world where valuations are below replacement costs, you're just not going to see a lot of development. And by the way, that's a big reason why we think that the cycle is in recovery stage, and this will be a long cycle, because cycles usually don't come to an end when there's no supply. They usually come to an end when there's a tremendous amount of supply. But let me give you an example of where we think there could be an opportunity to build new product. And you're probably going to fall out of your chairs when I tell you this.
Well, and that wraps up part one of our episode with Richard Hill. We hope you enjoyed the episode. We talked about a lot, from Richard's background to how he became the head of research at Principal Asset Management. And then we learned a lot about how Richard and his colleagues are thinking about the market today, how this real estate market cycle may be different from those in the past, and much more. And so we decided to break this up into two parts, because we got Richard for a lot more time than we expected. And he dives into topics like data centers, industrial, investing in tertiary markets versus primary markets, and much more. So please stay tuned for episode 2, or part 2 rather, which we will be releasing to you shortly. Thanks again for joining the Redirect podcast, and I am your host, Jonathan Spitz. We'll see you next time.
All right, well, that wraps up this episode of the Redirect podcast. Thanks for joining us and listening in today, just to hear a little bit more about how institutional real estate investors are thinking, so you, the individual, can approach capital allocation with some greater clarity and discipline. If you found today's episode at all valuable, we'd love to hear from you. Feel free to please reach out and provide feedback, share how you're viewing the markets, and start a conversation with John or I. To learn more about Lightstone Direct and our approach to investing, you can find us online at lightstonedirect.com or reach out to John and I directly. We will be back very, very soon with our next conversation.
The information provided in this podcast is for informational and educational purposes only and should not be construed as investment, legal, tax, or financial advice. The views and opinions expressed are those of the host and guest as of the date of recording and are subject to change. Nothing discussed in this podcast constitutes an offer, solicitation, or recommendation to buy or sell any securities or investment products. All investments involve risk, including the possible loss of principal. Past performance is not indicative of future results. Listeners should consult their own financial, legal, tax, and investment advisors before making any investment decisions.